Welcome. If you're looking for the essential insights, the core knowledge from the latest report of the company that, well, literally makes the modern digital world possible, you are absolutely in the right place.
We really appreciate you taking the time to come and watch.
Our mission today is, crystal clear. We are doing a focused deep dive into the official source materials, the Form 6K, and the presentation that goes with it.
All covering the, frankly, spectacular Q4 2025 financial results for Taiwan Semiconductor Manufacturing Company.
But are known to everyone, of course, as TSMC.
And hey, before we get into these massive numbers, if you find this breakdown helpful, please do us a favor.
It really helps the channel.
It does. We strongly suggest you like, share, subscribe, and of course, stay tuned for more content just like this. We're driven by this complexity, and your support, well, it allows us to keep digging.
Exactly. And please consider evaluating a channel membership. It's the best way to support us in making these ongoing videos.
And don't forget, you can always show your support with super thanks.
Okay, so
Yeah.
we're not just reading a spreadsheet here. We are translating this dense financial filing into plain English. We're focusing on what drove this quarter, what the results mean for the broader tech ecosystem, and this is the big one, dissecting their unprecedented outlook for 2026 and the years beyond.
You really cannot overstate TSMC's position. I mean, they're not just a semiconductor foundry.
Yeah.
They are the world's leading dedicated foundry. Their financial health is basically the heartbeat of global technology.
Pulse, yeah.
The sources state that in 2025 alone, they served 534 customers. And get this, they deployed 305 distinct process technologies.
Wow.
So when TSMC performs well, it means AI, it means high-end smartphones, next-generation computing. All of it is thriving.
They are the economic bedrock. You put it perfectly. If their engine is running hot, the entire tech sector is running hot. So let's jump straight in. Section 1, the high-level scorecard, looking at the Q4 2025 performance.
Let's do it.
The top line headline is one of, almost unbelievable strength. The CFO, Wendell Huang, he stated it clearly. He said the business in the fourth quarter was supported by robust demand for their leading-edge process technologies. This wasn't just meeting expectations.
Not at all.
This was a significant, profitable surge that closed out a record-setting year.
And to really understand the, let's call it the velocity of this performance, we need to compare 4Q25 against two benchmarks.
Okay.
First, the third quarter of 2025, so quarter over quarter, or QOQ, and the fourth quarter of 2024, year over year, or YOY.
Right.
The analogy made is perfect, that this engine isn't just turbocharge, it's achieving peak thermal efficiency. More output, less comparative cost.
Let's get into the key financial metrics then, because the raw scale here is just astounding.
Yeah.
And there's a critical detail about currency conversion we need to pull out right away.
Absolutely. Let's start with revenue, so consolidated revenue.
Okay.
In new Taiwan dollars, or NT dollars, revenue hit NT 1,046.09 billion.
Which is over $1 trillion NT dollars.
Right. This was a massive increase of 20.5% year over year and a very strong 5.7% quarter-over-quarter jump. That shows momentum building all year long.
And in U.S. dollars.
In U.S. dollars, the consolidated revenue was U.S. $33.73 billion. Now, critically, the year-over-year growth in U.S. dollar terms was 25.5%.
Wait, hold on a second. Stop right there.
Yeah.
You said 20.5% growth in their local currency, the NT dollar.
Correct.
But 25.5% growth in U.S. dollars, that's a 5 percentage point gap. That's enormous when you're talking about billions of dollars. What a huge difference.
That is a crucial point of insight for anyone listening. It all comes down to currency conversion rates. TSMC reports in NT dollars, that's their home base. But the U.S. dollar figure is calculated by converting those revenues using the average exchange rate for the quarter.
So what you're saying is the NT dollar got weaker against the U.S. dollar over the year.
Precisely. The NT dollar depreciated relative to the U.S. dollar between Q4 of 2024 and Q4 of 2025.
So just to spell it out, even if they sold the exact same number of wafers for the exact same NT dollar price, when they convert all that foreign revenue back into a relatively stronger U.S. dollar, the final number just looks bigger. It looks like stronger growth.
Exactly. It's a currency tailwind.
Yeah.
It means the 20.5% growth in NT dollars is the, let's say, the true operational growth measure.
Right. The boots on the ground growth.
But the 25.5% growth in U.S. dollars is that headline metric that captures investor attention and frames their global competitiveness.
Yeah.
Both are spectacular, but you have to acknowledge that currency provided some extra lift.
Okay, that makes sense. Let's move on to net income and EPS, because those numbers are even more dramatic.
They really are. Net income soared to NT $555.74 billion. That's an incredible increase of 35.0% year over year
35%.
and 11.8% just from the last quarter.
So their profit growth is almost double their revenue growth.
Yes. And the diluted earnings per share, or EPS, it matched that phenomenal growth perfectly. It was NT $19.50, reflecting that same 35.0% YoY and 11.8% QoQ expansion.
And for U.S. investors,
That translates to US $3.14 per ADR unit.
that 35% growth in net income year over year, that's really the most shocking number on this whole scorecard for me.
It suggests incredible operating leverage.
Right. They grew revenue by about 20% in their own currency, but net income jumped 35%. Which brings us right to our first big takeaway: exceptional margin expansion. This was the real surprise factor.
This is absolutely the real story of the quarter. We have to look at their margins, especially when you compare them to what management themselves were expecting. This is where TSMC signaled true market dominance.
So let's see the numbers.
Okay, their key margin metrics for Q4 2025 were, first, gross margin, 62.3%.
62.3.
Operating margin, 54.0%. And net profit margin came in at 48.3%.
Okay, let's unpack this because it was a monumental beat against their own guidance. What were they guiding for?
They had told the market to expect a gross margin between 59.0% and 61.0%.
And they hit 62.3%. That's more than a full percentage point above the high end of their own range. At this scale, every tenth of a point is worth hundreds of millions of dollars.
And it gets better. Their operating margin guidance was 49.0% to 51.0%. They achieved 54.0%.
A 3 percentage point beat on operating efficiency. That's insane.
What's fascinating here is what that 62.3% gross margin signals structurally. I mean, a 3.3 percentage point year-over-year increase. It was 59.0% in Q4 of 24. That's not just, cyclical noise.
Yeah.
It's a strong indication of a dominant market leader passing a critical inflection point in its manufacturing efficiency.
Explain that inflection point. Are they just raising prices like crazy, or is there something else going on, a technology factor?
It's overwhelmingly the technology factor. It's technological maturity.
Okay.
So when TSMC starts to ramp up a new node, like the 3-nanometer tech we'll talk about later, the initial yields are, well, they're not great.
They're lower, right, more defects.
Exactly. And the cost of production is astronomical. But as the quarters go on and they refine the process, the yields improve, the massive fixed costs, like those huge EUV machines, they get amortized over more and more units. And the cost per functional chip just plummets.
Yeah, I see. So that massive margin beat suggests that their newest, most complex technology, the 3-nanometer node, is now yielding chips at a highly efficient rate.
A highly efficient and profitable rate. This gives them world-class cost control combined with incredible pricing power. Because, frankly, no competitor can reliably match this yield or this scale.
That's the definition of a deep, profitable competitive moat.
It is.
So the incredible Q4 margin isn't just about selling more stuff. It's about the fact that the things they are selling now cost them less to make, even though they're the most advanced products on the planet.
Absolutely. And this strength confirms the trend for the entire year. The sources showed the full year 2025 gross margin was 59.9%.
Okay.
That's up 3.8 percentage points from 56.1% in 2024. So Q4 wasn't an anomaly. It was the culmination of highly successful operational and process improvements across their entire tech spectrum.
They are systematically becoming more profitable by mastering complexity.
That's a perfect way to put it.
And this efficiency, it just fuels the future. Before we move on, let's quickly look at their immediate forward view. The first quarter 2026 guidance also reflects this momentum.
It does. They're guiding for revenue between US $34.6 billion and US $35.8 billion.
And the margins?
This is the wild part. Gross margin, 63% to 65%.
Whoa. So even higher than the record they just set.
And operating margin, 54% to 56%.
Incredible. That guidance alone speaks volumes. We'll dig into that more in Section 4, but just note that management is asking the market to expect even higher margins next quarter.
They believe the factors driving that 62.3% record are accelerating, not decelerating.
Incredible. Okay, that monumental profitability demands we now look under the hood. What exactly is selling so well? This brings us smoothly into Section 2. The operational deep dive, the engine of their growth.
Let's get into it.
Our second big takeaway is the dominance of advanced technologies. When we talk about TSMC, we are primarily talking about their leading-edge nodes, which they define as 7-nanometer and more advanced. For our listeners who may be new to this, what is a nanometer in this context? Why does being more advanced matter so much?
Great question. So a nanometer, or NMM, it refers to the typical size of the smallest features on a microchip, specifically the gate length of the transistors.
So smaller is better.
Smaller is everything. A smaller nanometer number like 3 nanometer versus, say, 28 nanometer means the transistors are smaller. This allows engineers to pack exponentially more of them onto a single piece of silicon.
And why does that matter?
Because packing more transistors means dramatically increased computing power, it means reduced energy consumption, and it means superior performance for advanced applications. Think AI training, high-end graphics processing.
Right, everything that's driving tech today.
Exactly. And the operational reality for TSMC in Q4 of 25 is that this advanced technology segment, so 7mm and newer, contributed a staggering 77% of their total wafer revenue.
77%. So more than 3 out of every $4 they made came from their most difficult and valuable technology.
Precise.
Let's break down that 77% contribution because it illustrates a rapid, ongoing technological transition.
It really does. So in Q4, the 5-nanometer chips, which are mature but still bleeding edge for many applications, they accounted for 35% of revenue.
Okay, that's the workhorse.
It is. But then you have the newer 3-nanometer chips, which accounted for an astounding 28% of revenue.
Wow, 28% from 3-nanometer. That is the flashpoint, isn't it?
It really is. I mean, seeing a technology that requires such massive specialized investment ramp up to nearly 1/3 of your total revenue this quickly is frankly unprecedented.
It shows how desperate the market is for this level of performance.
Desperate is the right word, particularly among their key hyperscale customers.
And then the established 7-nanometer node rounded out the advanced technologies at 14%.
Right. And if we connect this all back to the margin story we just discussed,
Yeah.
this dominance of advanced nodes is the cause of that 62.3% gross margin. They are selling extremely high-value intellectual property that's been etched into silicon.
It's not a commodity product.
Far from it. I mean, contrast that with the older nodes, 90mm, 65mm, and so on. Collectively, they make up less than 10% of their revenue. TSMC is actively prioritizing capacity away from those commodity-like chips to focus entirely on being the leader in miniaturization.
Securing that competitive moat.
Exactly.
So the technological lead is clear, but who is buying all these premium chips? That brings us to takeaway 3. The high-performance computing platform, or HPC, is leading the charge, and its growth is truly spectacular.
Yeah, analyzing the Q4 revenue by platform, it just confirms the primary demand driver. HPC high-performance computing dominated the quarter. It accounted for 55% of total revenue.
55%. And for the listener, when we say HPC today, we're not just talking about supercomputers anymore, are we?
Not at all. We are talking almost exclusively about the infrastructure required for the AI boom.
Right. GPUs for training large language models.
Custom high-end chips for data center acceleration, advanced processor architecture. All of that falls under HPC.
Okay, and what were the growth dynamics in the quarter?
So HPC grew a solid 4% quarter over quarter, which is very strong considering its massive base.
Right, it's hard to grow a big number.
Exactly. And then smartphone, which is 32% of revenue, grew 11% QOQ, which reflects that expected seasonal strength leading into the holiday consumer electronics cycle.
But the truly transformative story is the year-over-year view for the full year 2025.
This is where it gets crazy.
If we look at the full 2025 revenue by platform, the picture of where TSMC's future lies is, it's undeniable. HPC was 58% of the annual total revenue and showed spectacular growth of positive 48% year over year.
A nearly 50% growth rate in their largest segment. It's not just a strong result, it validates the entire industry narrative about the AI infrastructure expansion.
TSMC is literally the manufacturing floor where that infrastructure is being printed onto silicon.
100%. And this growth rate, it just eclipses every other category.
So if we contrast that with the other major platforms.
Well, automotive, while growing robustly at plus 34% YoY, which is great.
Still great, yeah.
And smartphone, growing a respectable plus 11% YoY. The implications are clear. TSMC's massive capital investments are directed at feeding the seemingly endless appetite of AI companies and hyperscale data centers for 3nm and 5mm chips.
So yeah, the outsized contribution of HPC means TSMC is now intricately linked to the sustained multi-year expansion of AI and high-speed data processing.
They are the essential, indispensable manufacturing partner for these technology leaders.
Now, even with such powerful overall figures, the report notes some curious cases in other segments. It shows that natural cyclicality in tech demand.
That's correct. Despite the strong headline numbers, you see variations that highlight sector-specific realities. Digital consumer electronics, or DCE.
So gaming consoles, smart TVs.
Right. That dropped significantly, down 22% quarter over quarter. And automotive, despite that phenomenal yearly growth, saw a minor sequential decrease of 1% QOQ.
And what about IoT, the Internet of Things?
IoT, which covers sensors, smart devices, lower power chips, that grew slightly at 3% QOQ.
But here's the detail that I think really connects all the dots. It's the wafer shipment data.
Yes. This is so important.
Shipments of 12-inch equivalent wafers actually decreased 3.0% quarter over quarter. They fell from about 4.1 million pieces in Q3 to under 4 million in Q4.
Which looks contradictory.
It looks completely contradictory when revenue is up 5.7% in their local currency.
That apparent contradiction is the single most important operational insight of the quarter.
Explain that. Fewer physical units shipped, but way more revenue and spectacularly higher margins. What's going on?
It means the value embedded in each and every wafer is skyrocketing. They traded volume for value. The minor dip in volume was likely caused by that softness in DCE and automotive. But the overwhelming shift in the product mix toward those high-priced, high-complexity 3nm and 5mm chips.
It more than compensated.
It completely compensated, leading to the revenue and margin beats. They're selling the world's most expensive real estate etched into silicon, and they're selling less of the low-rise housing.
It's an elegant demonstration of strategic focus. TSMC has prioritized technological leadership and margin over pure volume metrics.
And the market is validating that strategy in a big way.
This success has now given them the mandate for a truly staggering commitment to the future, which leads us to Section 3, financial health and investment posture.
Let's get into the financials.
Takeaway 4 is perhaps the clearest window into the mind of TSMC management. Massive investment and confidence. They aren't just reporting strong results, they are using the success to double down on the future. And we have to start with the CapEx figures.
The CapEx numbers are eye-watering.
The projection for the 2026 capital budget is between US $52 billion and US $56 billion.
$56 billion.
That is an almost unfathomable amount of money for one company to spend in 1 year on building new fabs, securing advanced tools, and expanding R&D.
And just to contextualize that figure for everyone, the full year 2025 capital expenditures were already NT 1,272.41 billion.
Which was a huge jump over 2024.
A remarkable 33.1% increase. So the 2026 forecast implies they are maintaining this hyper-investment pace. They're just pushing the boundaries of what a single company can invest in its own future.
I mean, that amount is comparable to the annual GDP of a small country. Why does a company need to commit over $50 billion in 1 year? Doesn't that expose them to massive risk if this AI boom slows down? I imagine a more cautious approach might be warranted given the history of semiconductor cycles.
That's a critical question, and it reveals the structural change that's happened in the market.
Okay.
This massive commitment ties directly back to that 48% growth in HPC revenue we talked about. TSMC isn't betting on a short-term bubble.
They're betting on something bigger.
They are betting on a fundamental secular shift where computing power, driven by AI, needs to scale exponentially every single year.
I see.
By committing $56 billion, TSMC is essentially signing a multi-year, non-binding contract with its biggest customers. The Apples, the NVIDIAs, the AMDs of the world, and they're saying,
I believe you.
We trust your demand forecast for the most advanced chips for the next 5 years, and we are building the exclusive capacity you will need to meet it. It reinforces the belief that this boom is long-term.
So failure to build this capacity would be a bigger risk than building too much.
A far greater long-term risk. Ceding market dominance is not an option.
So it's a defensive move as much as an offensive one. They have to build it because if they don't, someone else might try to, and they can't afford to lose that technological high ground.
Precisely. And a bet of that magnitude, it requires a fundamentally healthy balance sheet. Which brings us to Section 3.2, balance sheet strength and liquidity.
You can't make a $56 billion commitment if your finances are fragile.
You cannot. And reviewing their key balance sheet indices as of Q4 confirms their rock-solid financial foundation. Total assets stood at NT 7,933.02 billion.
Okay.
And crucially, total shareholders' equity was NT 5,460.79 billion. That accounts for 68.8% of assets.
Wow, so almost 70% of the company is funded by its own equity, not debt.
It's an incredibly high proportion. It signals a highly conservative, equity-heavy funding structure. They rely on their own retained earnings, not external debt, to fund this enormous growth.
And that high percentage of equity gives them immense financial resilience against any economic shocks. What about liquidity? their ability to cover immediate bills.
Liquidity is excellent. The current ratio was 2.6 times.
Meaning?
It measures current assets against current liabilities. A current ratio of 2.6x means they have $2.60 in liquid assets for every dollar of short-term debt they owe.
So plenty of cash on hand.
Far more than required, which is essential when you have these complex, multi-billion-dollar fabs under construction.
And efficiency remains top tier, even with all these complex ramp-ups.
Yes. Inventory turnover days remain stable at 74 days. That's actually an improvement from 80 days in Q4 of 24.
So the chips they make are being shipped out almost immediately.
It shows remarkable efficiency. They're managing extremely complex, high-value inventory without it building up. A testament to world-class supply chain coordination.
And speaking of funding this massive growth internally, what's the debt situation look like?
Long-term interest-bearing debts remain very manageable. They actually decrease slightly to 11.3% of total assets.
So this is a company funding monumental growth through its own profits, not through risky borrowing.
Exactly. It's through retained earnings and spectacular internal cash generation.
That transition is perfect because the source of this internal funding is free cash flow, or FCF. This is the proof that all that operational excellence is translating directly into financial power.
It is.
So free cash flow is the money left over after a company pays for all its operating costs and, critically, for its capital expenditures. For Q4, FCF was NT 368.6 billion dollars.
Which is calculated by taking cash from operations, which was NT $725.51 billion, and subtracting that quarterly capex of NT $356.91 billion.
Now, if we compare that to the previous quarter.
This is where the true scale of the margin expansion becomes visible. In Q3 of 2025, free cash flow was NT $139.38 billion.
So the Q4 result represents a more than doubling of free cash flow.
A doubling in just 3 months.
A doubling of cash flow in a single quarter for a company of this size is genuinely shocking.
It connects right back to that inflection point we discussed earlier. This surge in FCF is a direct consequence of the 3nm yields maturing and the product mix shifting so heavily toward those high-margin HPC chips.
So that immense cash generation is the financial engine that makes the $52 to $56 billion capex forecast for 2026 entirely credible.
Yes, they aren't just saying they plan to spend it. They are actively generating the cash required to finance it themselves.
And this cash flow isn't solely reserved for future fabs. It's also immediately rewarding shareholders.
That's right. The board approved a cash dividend of NT $6 for Q3. And for the full year 2025, total cash dividends came to NT $466.78 billion.
Which is a huge increase.
A 28.6% increase year over year.
This is the ultimate sign of confidence, isn't it?
It really is. They are simultaneously accelerating investment into capacity for future growth and significantly increasing dividend payouts today. They believe the market is expanding so rapidly and their position is so secure that they can deliver immediate value while building unprecedented scale for the future.
That belief system sets the stage perfectly for Section 4, the path forward guidance and long-term outlook.
We have to begin by revisiting that 1Q26 guidance. And we always have to remember the safe harbor notice results may differ, but this guidance is management's clearest assessment of current demand and their operational health.
And it was strong.
Very strong. The revenue expectation is for robust sequential growth. They're projecting US $34.6 billion to US $35.8 billion.
Which is impressive given that the first quarter often sees a seasonal slowdown after the holiday rush.
Exactly. Forecasting growth over an already record-breaking Q4 is a strong indicator of demand.
But again, the margin guidance is the real key. They just hit a record gross margin of 62.3% in Q4. And now they're guiding for Q1 to be between 63% and 65%. I have to push back on this a little bit. Is management being overly optimistic here? To guide for a 65% gross margin means they anticipate a near-perfect operational environment, continued favorable currency conversion.
Right. They assume $1 to 31.6 NT dollars.
And zero production hiccups. Is this achievable, or is this just aggressive signaling to the market?
It's aggressive signaling, but it's signaling that's anchored in reality. It suggests two things.
Okay.
First, that their yield improvements on 3nm are still accelerating, meaning their cost structure is still rapidly improving. And second, it suggests their most valuable customers are continuing to aggressively pull demand forward for those chips.
So it's not just a bullish forecast.
It's a statement that the structural improvements of 2025 are compounding powerfully into 2026. A 65% gross margin at this scale is just an astonishing display of technological and commercial leadership.
And that confidence isn't limited to the next 3 months either. Our fifth takeaway is the long-term market projection and these numbers. They require us to reset our understanding of what growth even means for a massive corporation.
They really do.
Let's focus on the near term first. For the full year 2026, management expects revenue to increase by close to 30% in US dollar terms.
30%. This follows a 25.5% US dollar YoY growth in 2025. This isn't just growth, it's hyper-growth for a company that's already generating over $120 billion in annual revenue.
And now let's widen the lens to the midterm outlook from 2024 to 2029.
Management expects revenue CAGR, that's compound annual growth rate, to approach 25% in US dollar terms over those 5 years.
Okay, that is perhaps the most crucial metric they revealed.
I think so too. A 25% CAGR forecast for 5 consecutive years for a foundational infrastructure provider like TSMC. It fundamentally shifts the narrative from, a cyclical industry
Boom and bust.
to a secular growth engine. This shows their unwavering belief in a sustained long-term trend driven by fundamental, unavoidable changes in technology consumption.
Specifically AI.
Specifically, ubiquitous high-performance computing, the proliferation of AI at every level of the network, and the continuous need for miniaturization.
But let's play devil's advocate again. To grow revenue by 25% compounded for 5 years, TSMC would need its market, the custom chips, the HPC chips, to essentially quadruple in size over that period.
That's right.
What are the key risks that could derail this enormous 5-year forecast?
Well, the risks are significant, but they fall into 2 categories: external and internal. Externally, the biggest risk is a macroeconomic slowdown that dampens corporate IT spending,
Of course.
or a sudden tech shift that lessens the importance of leading-edge silicon. But the elephant in the room, the most important external risk, is geopolitical stability, given the location of their primary manufacturing base.
And internally?
Internally, the risk is all about execution. To hit 25% CAGR, they must successfully execute that $56 billion CapEx plan and maintain their technological lead, especially in moving from 3 nanometers to the next node, 2 nanometers and beyond.
So any delay could be critical.
Any significant delay or failure in ramping up those future nodes could immediately open the door for competitors, though that moat is currently extremely deep. The 25% target is not a guarantee, it's a forecast based on flawlessly executed R&D and manufacturing.
That level of risk, however, is mitigated by their stated long-term profitability targets. They're reassuring the market that growth won't come at the expense of financial discipline.
Exactly. They expect their long-term gross margin to be 56% and higher through the cycle.
Even 56% is world-class for a manufacturer, and establishing that as a long-term floor guarantees robust returns even if performance dips below these current 60% plus records.
And their return on equity, or ROE, target is highly ambitious. They're aiming for the high 20s% through the cycle.
And how did they do in 2025?
Their 2025 actual ROE was an impressive 35.4%, so they are currently operating far above their long-term floor, which shows extreme efficiency in converting shareholder capital into profitable growth.
Before we move to our final thought, let's briefly touch on the recap of recent corporate events, just to round out the operational calendar for Q4.
Certainly. Beyond the financials, we noted the strong governance commitments, including the board approving that $6 cash dividend for Q3, showing their commitment to shareholder returns.
And their focus on their ecosystem is clear. They mentioned the 2025 Supply Chain Management Forum in late November, where they recognized outstanding suppliers. This might sound like a simple PR event, but it's fundamentally vital.
It is the absolute foundation of their success. You cannot execute a $56 billion CapEx plan and maintain 62% margins without a world-class, trusted, and highly incentivized supply chain.
Right.
The quality of those suppliers determines the purity of materials, the efficiency of their equipment, and ultimately the yield rate on those ultra-complex 3nm chips.
So this dedication to supplier quality is what makes that 25% GGR forecast even feasible.
It all connects. Supplier quality drives 3nm yield, which drives margin expansion, which doubles free cash flow, which funds the $56 billion CapEx, which enables the 25% CAGR forecast.
It's an aggressive but financially validated virtuous cycle.
To summarize this extensive deep dive, TSMC closed 2025 with record margins and profitability, significantly exceeding all of their prior management guidance.
And this spectacular financial health wasn't an accident.
Not at all. It was driven almost entirely by the relentless and accelerating demand for its most advanced nodes, the 3nm and 5nm technology, which was fueled overwhelmingly by the high-performance computing segment.
The company's outlook is exceptionally bullish. Their guidance for Q1 of 26 suggests even higher margins, and their long-term forecast of approaching 25% revenue CAGR through 2029.
Backed by that massive US $52 to $56 billion CapEx commitment.
It suggests management is anticipating years of sustained transformative growth, secure in their indispensable role in the AI and high-performance computing supply chain.
What stands out here to me is not just the 35% growth in net income for the quarter, or the rapid maturation of the 3-nanometer node that drove those margins.
It's the confidence.
It's the sheer confidence to project a 25% compound annual growth rate over the next 5 years.
Which brings us to the final provocative thought we want to leave you with. Considering the sheer scale of investment, $56 billion, and the unprecedented growth rate TSMC is betting on, what specific component of the global tech economy, beyond today's current definition of AI, do you think requires the sustained, multi-year, exponentially increasing computing power that TSMC is preparing to supply?
Is it personalized medicine? Autonomous infrastructure?
No.
Or something else entirely?
It's a fascinating question that defines the next decade of technology, and one worth exploring as you track the broader landscape. Thank you so much for joining us for this deep dive into TSMC's financials.
We truly appreciate you watching and listening. If you found this discussion valuable, please click like, share the video, subscribe to the channel, and stay tuned for our upcoming content.
And we kindly encourage you to evaluate membership to support our channel as we continue to make ongoing videos. It ensures we can deliver this level of detailed analysis.
And as always, if you want to show your immediate support for the work we do, you can use Super Thanks.
We'll catch you on the next one.